Thank
This
you, Amanda.
conference will now be recorded.
Welcome to Investing Basics. This is going to be presented by Wakota Federal Credit Union's partner, Servion Financial Advisors, David Murdoch. Go ahead, David.
Thanks, Amanda. Uh, Welcome, everyone. I want to commend you for committing some time to gaining some knowledge about investing basics and maybe being able to enhance your financial strategies going forward from today. Uh, I've been an advisor with the Wakota members for about 20 years. Next month, I'll be celebrating 30 years as a financial advisor. So, doing this presentation today, Investing Basics, I'm excited about doing it. I think it's got really good material. It's also good to always get a refresher in the basics. So, with that, I'll get started. This presentation is put on by BlackRock. BlackRock is a mutual fund company, one of many that we can use. It's not intended to be a promotion of BlackRock today. It's just some good material that we wanted to use to share with you all. So start right here with slide number 1, investing basics. We're going to cover the fundamentals of investing basics today. I think that slide jumped around on me. And primary thing, invest in yourself. Some research that was done, 74% of non-investors in the US have recognized that their future outlook would be better if they started investing now. Probably common knowledge, but it's hard to get started. Here's why. 64% say information on investing is difficult to understand. So hopefully today we can break it down a little bit for you, make it a little bit easier to understand and not seem so complex. Here's why it feels complex. It can be overwhelming. You see all different types of investing capabilities here. And the ones that jump out are in the corner: stocks, bonds, mutual funds down below. But you see ETFs, securities, puts, options, IPOs. It is overwhelming. There is a lot to know. Today we'll be focusing on stocks, bonds, and mutual funds, a little bit of ETFs as well, and getting into the details of those. And I think when we're done, you'll have a better understanding of how all these work. The fun part about this today is that it's tied into cooking, knowing the ingredients and the recipe to be successful as an investor. So you'll see a little bit of food here. Hopefully, you've got some lunch with you and you're not going to get too hungry watching this investing basics presentation. So, know the ingredients. It's very important to know what you might be utilizing as investments going forward, and a basic understanding will go a long way with investing. So, right off the bat, what is saving versus investing? And I think this is a very important concept for a couple of reasons. Uh, First of all, savings is very important to your immediate needs in life and emergencies. Think of it as a short-term account that you would have with little to no chance of losing any money. With that little bit of risk comes very little return as well. But the savings piece is incredibly important compared to the investing piece. Investing is a long-term strategy. There's more risk, there's a higher chance of losing money, and you also have a higher chance of return. So know the role savings and investing play. And this is a really good slide, one I want to emphasize for you. How long does the money need to last? And so you see in the savings category, daily for everyday needs, financial safety, 6 to 24 months. And the savings will give you not only financial safety, but if you have an adequate emergency fund, one that can last through maybe a job loss or any kind of inability to work, or maybe just the ability to choose a different career path, A healthy savings account gives you that financial freedom to be able to make decisions that without it you wouldn't be able to make. On the investment side, um, building wealth, that's the most important thing you need to do for if you want to have a successful retirement. 1 year or more. Typically, we say if you're going to be investing, you want to have a 3-year time horizon. Uh, Investing will give you and your investments financial freedom and beyond maybe what you could comprehend, because once you build those assets with a strong savings account and then investments to complement that, it really does give you financial freedom. And for your lifetime and beyond, if you do well with your financial strategies and your investments, you can create a legacy for children and family that will certainly benefit from strategies you begin to employ now. So, very important to have a strong savings emergency fund. And then once you build that up, to move on to investments and create some financial freedom. Inflation. This is another one that's really important to understand and how it impacts your investing strategy. And it's called the silent roadblock to your goals. So this is a really good illustration here, this graph that can help you understand the damage inflation can do to your savings and investments. So it's kind of a fun example with the average admission price to a movie theater over the years. It's the average ticket price per decade, including all theaters and showtimes. So if you look at the top selling movie in 1950, it was Cinderella, and you would have spent 46 cents for a ticket to go see Cinderella. With a $20 bill, you could have brought 42 friends. So that's pretty impactful compared to what happens as you move along the time horizon here. 1980, Empire Strikes Back. I'm sure I saw that 2 or 3 times. That ticket would have cost you $269. And if you move all the way out to 2020, 70 years since Cinderella, Avengers Endgame in 2019 cost $9.16 to buy a ticket. So you could have purchased 2 movie tickets for $20. So the impact of inflation here is that your money buys you less. The $20 bill over 70 years buys you much less than it did in 1950. And that's something you can apply to a savings scenario. If your money's not at work, if it's not invested, and you're getting a minimal interest rate, um, there's a good chance that inflation will reduce your purchasing power. So if you look at the graph and you see that over that period of time, inflation annualized was 4.4%. You were maybe earning 2% in a savings account. What that means is inflation eroded your purchasing power to the tune of 2.4% a year. So what your dollar can buy today will buy you less in a year from now due to inflation, unless you're investing and getting a return that's at least equal to or greater than the inflation rate. We're all suffering right now with a very high inflation rate. Savings rates have gone up, but they're still well below what inflation is currently. So again, it's important to make sure that you have some of your money at work, attempting to at least get an equal return to what inflation is and hopefully exceed it. So here's what I mentioned earlier, examples of investing and savings, the investment spectrum, keeping it very basic here to start. You see with the lower risk and lower potential return is cash. And as you start to move up the risk spectrum, you see you have bonds, which are carrying a little bit more risk, also a little bit more return potential. And then stocks would provide you the highest amount of risk and the highest return potential. So we'll get into right now what are stocks and what are bonds, because I think a lot of times people hear about it but don't really talk about it. Stocks, when you buy a stock, you're an owner in a company. And so that's significantly different, being an owner in a company, than buying a bond and loaning a company money. So stocks is ownership in a company, and bonds is helping a corporation or government entity raise money by loaning them money, getting paid interest along the way, and at the end of the term of the bond, getting your principal back. Big difference in the two. Stocks will carry more risk and more return potential. Bonds are safer with a mid range return depending on the interest rate environment. So it's very important with your investing, just like cooking, stick to the recipe. There is a lot to know, but sticking to the basic recipe and the basic ingredients will make a huge difference in your success as an investor. So we're going to cover right now portfolios and diversification. And to put it simply, creating a diverse portfolio is one of the most important things you can do. A portfolio is essentially a collection of assets, like stocks and bonds, like we just discussed. And you would do that within an investment account. Having a diverse portfolio would mean that you have a lot of different assets, not all stocks, not all bonds, or not all one investment type. You might have different types of stocks. You could have different types of bonds. But having the diversification of your portfolio is very important, and we'll come across a slide that illustrates that really well in a little bit. So balancing risk and reward is incredibly important, especially as a new investor. But to any investor, balancing your risk and reward is a key to being successful. More return you get, the more risk you take on. So average annual returns for various asset classes since 1926. So these numbers are steeped in a lot of historic data. Cash and savings, 3.3%. So think about that. If inflation all this time has been 3 to 4%, and your cash and savings has earned 3.3, you can see in this slide they've got inflation at 2.9 since 1926. So you barely outpaced inflation with your cash and savings. By the time you factor in the taxes you pay on the interest you earned, you're break even with inflation at best. Move up the ladder one notch with U.S. bonds. Out of 10 years, to give you some sense of the risk, out of 10 years, 1.1 year you lost money out of 10. The average return was 5, inflation being 2.9. Even after the effect of inflation and taxes, it looks like you probably would have been slightly ahead of inflation and not losing purchasing power on your dollar. And then stocks, out of 10 years, you lost money 2.7 out of 10 years, but your average return was also 10.5%. Those return differences are significant. And I'm not going to go into the details of the rule of 72 right now, but if I apply the rule of 72 to the 10% return in stocks, that means your money would double every 7 years, roughly. If you do that with bonds, your money would double approximately every 14 years. So that's a big difference and has a huge impact on how much money you have at the end when your money is doubling every 7 years instead of every 14. All right. So here's a eye opener about diversification. Different asset classes zig while others zag. And so here's a great example of a few time periods back in the last 2 decades where you can see a significant difference. 2002 was a very bad year for stocks. Stocks lost 22.1% in the calendar year 2002. By the contrary, bonds were up 10.3. So that would have been a year where you wish you would have been in bonds than stocks, not knowing ahead of time what that result was going to be in 2002. Having both is the best scenario. 2008, 37% loss in stocks. Aggressive investors were closer to 45%. Some lost 50% of their portfolio in 2008. If they had any bonds in their portfolio, though, they propped up their portfolio a little bit by earning 5.2%. So again, important to have asset classes that move opposite of each other to help balance your return out. So after those two horrible stock periods, 2002, 2008, you get to 2013, stocks are up 32.4%. A lot of investors may have cut back or abandoned stocks altogether after that very bad decade in 2000 to 2010. If they did, they missed out on 32.4% in stocks, and the bonds they may have moved to lost 2%. So you'll see that, keeping both in your portfolio, broadly diversifying, will minimize the losses and potentially have you experience a result higher than had you not just had one asset class. Here's another slide that I think is incredibly important to understanding investments and investment loss. And a lot of people, until it's pointed out to them, don't realize this is what's happening. So, understanding the math of investment loss. You go along the bottom there and you see that if you lost 5% in 1 year, in order to get back to even, you would have to have a return of not 5%, but 5.3%. Where it's more obvious and more difficult is if you decided you're an aggressive investor, you can ride out all the ups and downs in the market, and you've got an aggressive portfolio, and you slide over to the loss of 30%. In order to get back to the balance that you had before the market declined, you'd have to have a 43% gain in your investments just to get back to even. If we fall back on the example we just saw of the 2008 stock loss, where a lot of portfolios were down 37 to 45%. If you lost 40% in 1 year, you need to have a 67% return on investment in order to get back to even. Now, what makes that even more difficult is, in my experience over the last 30 years, a lot of investors that are down 40% in a year are inclined to react emotionally to the fear of losing even more and will get out of the market altogether. Then they'll miss the rebound, and you can only imagine how long it takes then to get back to even once you've jumped out of the market and not seen the recovery. It's important to know that in the stock market, you can go back as far as you want in the history of the stock market and know that there's not one period in the stock market where the market corrected and went down that it didn't recover and go higher. It's always recovered and gone higher. So that's an important investment fundamental to remember, but it's also important for you to see that, can I handle a 30% loss in any 1 year? Can I handle a 40% loss in any year? If I can, that's great. Stand your ground, hold on to your strategy, catch the recovery, but it's going to take a bigger recovery than you realize to make up what you lost. So, an important slide there. Good information to know. So, a balanced portfolio, a balanced, diverse portfolio is like a balanced, diverse diet. Stocks are important to hold, bonds are important, cash is important. Alternatives, those are things like commodities, real estate, some speculative vehicles. And think of that as a balanced diet. You want to have fruits, grains, vegetables, protein, dairy. Um, so it's a good comparison in terms of having a balanced investment strategy versus a balanced diet. So uh, next slide again is one of my favorites here to help you understand about diversified portfolios and why they're so important. And I like the title here. It says a diverse portfolio can work even though it doesn't often taste good. And that's so true. But I'd first just sort of point out to you, it says the last 20 years, and it's showing you what they're talking about with a diversified portfolio. So you see it's 25% US large company stocks. It's 19% US mid-sized company stocks. They call those mid-cap stocks. 7% international stocks. That means stocks of companies that are outside of the US. 5% of small company stocks, or what they call small cap stocks. If you're investing in a 401k plan at work, you might see something called SMID. It's small and mid cap stocks together. Uh, Again, continuing on, 4% emerging markets. Those have a lot of return potential and also a lot of risk. 25% US bonds, 15% in high yield bonds. So you've got bonds and stocks, small companies, large companies, international, emerging markets. It's a very diverse portfolio. And you can see the results here over time. 2002, 2000 to 2002, the S&P, which is not a diverse portfolio. It's simply an index that's made up of the 500 largest companies in the United States. In that time period between 2000 and 2002, the S&P 500 lost 40.1%. The diversified portfolio, which holds a lot of different kinds of stocks and bonds, only lost 15.7%. So as an investor, you say, I lost money, right? That doesn't feel good. But if you look at it in comparison to an investment that's not diversified, you did much better. But I guarantee you, the first thing you're going to feel is I lost money with my diversified portfolio. Why do I have it? 2003 to 2007, the S&P 500 index was up 82.9%. And the diversified portfolio this is the one time frame in here where you'll see that diversification worked. It actually outperformed the S&P by 87.1%. So that means all those other kinds of stocks, the small, the mid, the emerging markets, the international, all probably outperformed the S&P 500. Jumped to 2008, horrible year in the market. S&P 500 lost 37. Diversified portfolio lost 26.6. Again, you say, I lost money, but if you look at it comparatively to just the S&P 500, you didn't lose as much money. And now we have a good run in the market, 2009 to 2019, 10 years, the S&P was up 351, and your diversified portfolio was only up 220. I didn't make as much. You're going to feel terrible about your diversified portfolio. So you can see what's going on here. Jump down to the highlighted area. The total return over the last 20 years for the S&P 500 was 288.6%. Your portfolio grew to 388,000. However, the diversified portfolio did 301.6% and grew to 401. So it was about $13,000 more, even though in a lot of those time horizons, you didn't feel good about your diversified portfolio. Well, what's going on? Well, if I were to jump back to that last slide that showed how much you need to make in order to make up for the loss that you made, that's the difference here. Because in the years where there were losses, the diversified portfolio didn't lose as much. so it didn't have to make as much money to get back to even and create a gain for the time period. So um, this is a case where a lot of times it doesn't feel good to have a diversified portfolio, but in the long run, in most research I've ever seen, it pays off and ends up with a more consistent return, which is more important, and a slightly higher return. All right, so to get cooking, where do we start? What do we buy? How do we start investing? So here's a pretty simple solution to get started: mutual funds, uh, and exchange traded funds, which you probably know as ETFs or have heard of ETFs. A mutual fund is a basket of stocks or a basket of stocks and bonds that a professional investment company would establish. It trades at the end of the day, meaning if you were to call to get money out of a mutual fund, the money would come out once the market's closed, and they know exactly what the value of the mutual fund is at the end of the day. The ETF, on the other hand, is a mutual fund that trades throughout the day like a stock. So if you were to call and withdraw money for whatever your needs might be, and you did it at 1 o'clock during the day, you would get whatever the price is during the middle of the day when they place that order, not what the value is at the end of the day. So there's an advantage there in an ETF that if the market's on its way down all day long and you can get out of it before the end of the day, there's an advantage to maybe not losing as much. But in the long run, that difference is immaterial to investors. But that is the main difference with mutual funds and ETFs. Mutual funds are more often set up so that there's an active manager selecting stocks and bonds, which is important. ETFs are more often a replica of an index of some type, stock or bond index. Um, Using both strategies there together is a great solution. You've got money pooled together from many investors. You can hold hundreds, if not thousands, of securities. It can be a stock, bond, or balanced fund, which would hold both stocks and bonds. So there's a general description of the difference between mutual funds and exchange traded funds. Many of you are investing in both today if you're participating in your employer's 401k plan, because there are ETFs and mutual funds to choose from in your investment selection in almost all 401k or 403b plans, your retirement plans through work. How a stock or mutual fund or ETF works. So there are over 5,000 individual stocks to choose from. In the case of a mutual fund, you have a fund manager picking them. They're trying to pick the best possible stocks to own. The index methodology selects stocks for the fund based on the stocks that make up a particular index. These mutual funds or ETFs can own between 20 and 1,000 plus individual stocks. What that means to you as an owner is that you indirectly own those stocks through the mutual fund or ETF that you buy shares in. If you have a mutual fund or ETF that only owns roughly 20 stocks, that's what's called a concentrated fund. You're just investing in a few select. Typically, a fund manager would have, maybe a few select mutual stocks they would put in the mutual fund that they feel like are the highest quality to own, and it's more quality than quantity. 1,000 plus mutual fund with 1,000 plus stocks in it is very diverse. It's going to be more steady. It's going to be more consistent. It might not have as much return, but it also won't have the same amount of volatility that a concentrated fund would have. All right, this is a piece that talks about systematic investing, and it shows one, the ability to start investing early and how you can do it, but also the impact of investing early. So this is showing you invest early to reach your goals, monthly investment needed to accumulate $1 million by age 65, assuming 10% annual returns compounded monthly. So at age 15, if you could start investing $60 a month, you would have invested over the time horizon to age 65, $36,000. That would get you $1 million by age 65. If you wait 10 years and you start investing $100 more a month than you started when you were 15, if you waited those 10 years, you have to put $160 a month away to attain $1 million at age 65. And you can see as we progress along the graph here, age 35, another 10 years are gone, you start investing. That takes $440 a month. Age 45, you're over $1,000, $1,300 a month. And if you waited till you're 55, you have to save almost $5,000 a month and invest $582,000 to get to $1 million, compared to $36,000 if you just started when you were 15. Not many people start when they're 15, but a lot of people do start investing at a very early age, usually their first job, maybe 20, 21, and that's where you can make a huge impact in what you have when you get ready to retire. So here's what happens when you do systematic investing. And this is something you can do outside of work in a mutual fund. It's also basically what happens inside of your employer's deferred compensation plan. Maybe it's a 401k, a 403b, but you're systematically investing every month. And so this shows what happens over the course of a year with systematic investing. January 1, you invest $60 because that gets you one share. Hypothetically, you're investing $60 a month. Second month, February, the share price is still 60. Now the market started to decline, change a little bit on the stock that you're buying. Now the share price is 54. So you actually get more than one share. You're buying 1.1 shares. You move along and the stock's still declining, and it declines all the way down into July and August where the stock price has gone from 60 to 40. You're buying 1.5 shares. And then as you see, the market starts to recover and the share prices end up finishing the year at $66 a share. So you're buying shares all along the way at varying prices because the market's changing. And I have a lot of people who will come to me after they get maybe their mid-year statement and say, Dave, I'm not going to put any more money in my 401k. All the money I put in is worth less than what I started with. But you can see the advantage of continuing to invest, especially when the market's down, because you ended up, even though, on January 1, the share price was $60, with your systematic investing plan, your average price per share wasn't $60. It was $51.06, which means your average price is about $9 less than if you'd have just invested everything on January 1st and not done the systematic investing. The gain over the period is $210.60. So systematic investing is important. It has a lot of great benefits. It's slow and steady wins the race. Sometimes it doesn't feel very good, like diversification, but in the long run, systematic investing will often win out over lump sum investing. All right, where to invest? Just a quick, I'll do these fairly quickly here. You have your taxable brokerage account, retirement accounts, like I've been mentioning, IRAs, 401ks, 403bs. There's college planning account called 529s, which help you save money for college on a tax-free basis. So I'll just quickly get into the details of each of those. A taxable brokerage account is something like, we could compare your savings account at the bank or credit union and say, okay, I'm getting interest. I can put as much as I want in my savings account. You can put as much as you want after-tax money in your taxable brokerage account. Withdrawals subject to both income and capital gains taxes. Purpose is general wealth building due to tax implications. So at the end of the year in your savings account, you get a 1099 for the interest that you earned that you get to report on your tax return. The same with taxable and brokerage accounts, which often hold investments. As those earn dividends and capital gains, you have to report those yearly. But again, it's a great way to put away as much money as you possibly can without limits, be able to access it without limitation, and know that it's one of your strategies to build wealth. Fast facts on an IRA. And just if you're new to the retirement planning world, IRA is different, and consider it distinct and different from the plans that you use at work. IRA stands for Individual Retirement Account. If you were to open up an IRA separate from anything you do at work, you would be able to put away $6,500 a year in either a traditional Roth or a combination of the two. You could do both, but your maximum is $6,500 a year, $7,500 if you're age 50 and older, subject to income limits based on what your income is for each year. Withdrawals, they're taxed on traditional, not on Roth. Roth IRAs are tax-free if you own them for 5 years and you're at least 59 and a half years old. They may affect your income tax bracket on your withdrawals from an IRA. You have mandatory withdrawals starting at actually age 73 now. 73 is the new starting point for required minimum distributions. If you're to take money out of your IRA prior to age 59 and a half, with very few exceptions, you would be subject to an extra 10% penalty for early withdrawal. Purpose for your IRAs is long-term retirement focused savings due to tax advantage growth. So while you have money in an IRA, whether it's a pre-tax or Roth IRA, it grows without being taxed. It's tax deferred. Employer-sponsored retirement plans, you may have heard of them as 401ks, 403bs. 401k is a plan designed for groups of for-profit corporations. 403bs is designed for groups of nonprofit corporations. You can see in there you can save more money, $22,500 a year, $30,000 if you're age 50 or older. It's a payroll deduct contribution system. And often these plans have employer matching contributions, which don't count toward these limits that we see. Withdrawals, taxed on traditional, not on Roth. And now we're talking about a Roth 401k, not a Roth IRA, different animals. May affect your income tax bracket on withdrawal. A mandatory age, again, is 73. If you're to take money out before age 59 and a half, with very few exceptions, you're subject to a 10% early withdrawal penalty. Employer contributions are subject to a vesting schedule. Most plans have some type of vesting where your contributions are always 100% vested. The employer's contributions may vest over a period of time. It's often 3 to 5 years, where you have 3 to 5 years of service, you're gradually building 100% vesting. And once you've reached the vesting period where you're 100%, you're always 100% vested in that plan. Again, purpose is long-term. It's for retirement. Typically can't get the money out before age 59 and a half. And it's often the most efficient way to save money for your retirement because of the matching feature. And I believe that's what this next slide shows. Getting the most out of your retirement plan scenario is in the first situation, the employee is not putting any money away. Obviously, there's nothing building. Jump down to the highlighted section where the employee is putting 8% away. This particular employer matches 50% up to the first 8% of employee contributions. So if we've got an annual income for the employee at $100,000, they're putting away 8% for themselves. That's an $8,000 contribution for that year. The employer match would be $4,000. I like to refer to that as the employer is paying you to pay yourself. It's a huge benefit. It's the easiest money you'll make in terms of setting up for retirement. The total contribution after 10 years is 120,000, and if you had 3% growth on all those deposits, that 120,000 after 10 years was worth 141. So, very important to participate in your plan at work because it is the most efficient place to save for retirement, especially if there's a match where you're getting paid to pay yourself. There's another bar graph here showing the tax advantage options for retirement accounts, IRAs, and 401ks. So if you look at the first example on the left, contributions, hypothetical investor, younger than 50, making 75,000 a year and maxing out the 401k contributions. So the first column is the traditional retirement account. The second column is the Roth. So you can see that they're maxing it out. They put away 22,500. Because that contribution reduced their taxable income, their taxes were $68.58. Total take-home pay was $45,643. Compared to the Roth, where the Roth contribution of $22,500 is taxed, which means their taxes for that year were $11,800, $5,000 more than the pre-tax example. Total take home was $5,000 less, about $40,000. What happens on withdrawals with these two? You can see in the traditional hypothetical withdrawal, $75,000 in a single year after age 59 and a half with no other income. You take out $75,000, you would pay roughly $12,000 in taxes. Your take home is $63,000. On the Roth, because it's completely tax-free, $75,000 withdrawal is a $75,000 net take home. So that's a difference of $12,000. So the Roth can be a huge advantage in the long run. You want to make sure you have enough time to build up gains for the Roth to make sense for you. Here's some fast facts about college savings plans. Basically, a 529 is a place to save money for a child's nephew, niece, son, daughter's educational expenses, primarily college, but can also be used for pre-college expenses. But it's a way to save money. And if you use the withdrawals to pay for qualified college expenses, the gains are tax-free. So it's a great place to be able to build up tax-free money for college, which helps lessen a little bit of the blow of a very expensive 4-year experience or whatever private school they may be going to. You can see the details here. There's a lot to be able to be contributed if people are looking to give a lot of money. Total contributions cannot exceed $235,000 to $529,000, depending on the state. Typically, there's a $17,000 limit per donor, and that's based on the per beneficiary for gift tax exclusion. But again, it's a way to save money for college funding for kids and avoid taxes on the gains. So there's other ways to build wealth with investment strategies. You can set up a joint account where maybe a husband and wife set up an account together. Often those are joint tenants with rights of survivorship. You can set up accounts for minors with the Uniform Gift to Minors account, the Uniform Trust Minors account. Financial freedom, middle column, 457 plans. It's typically another employer-sponsored plan. Thrift savings plan, TSP, known to many government employees. Simple IRAs can help out self-employed people or small employers. SEP IRAs are for self-employed people. Profit sharing plans sometimes are added to 401k plans at an employer. And then health savings accounts and the flexible spending accounts are other tax advantage ways to save money for your retirement and future expenses. You want to create a legacy. Those can be the UGMA or UTMA accounts like we talked about. Trust account Coverdell is another one that's similar to a 529 where you can be saving money for future college expenses. So we're getting close to the end here. I want to wrap up with a little time for questions. Investing basics, know the ingredients, the difference between savings and investing, know the many reasons to save and invest, which we covered, I think, pretty closely. Stocks and bonds is an owner versus loaner situation. Stick to the recipe. Portfolios and diversification is very important. Knowing the risk and return the risk you're taking and the return you expect. The diversified portfolio is like a well-balanced diet. Sometimes it doesn't always taste good, but it's generally very good for you. Get cooking. It's easy to start mutual funds and ETFs. Systematic investing is one of those ways to make it easy to get started. And then there are a number of different ways to invest, where different types of accounts. So I hope that all was very helpful and at least gave you a better understanding of investing basics. Get started right away is the main message. Here's some important notes. Returns as of 12/31/2022. You can see the different categories, the S&P 500, large stock, mid-size, international, small caps is the Russell. You can see those returns for 10 years. 12 and a half, very good returns. 10, almost 11. And mid-sized companies, small companies return 9. If you stretched out those to 30 years, you'd probably see the mid caps and the small caps outperforming those large caps. But the last 10 years have been good for large caps. So there's the rest are bonds and short-term cash instruments, and you can see where those are minimal returns at best and probably not keeping up with inflation, which we talked about was very important. Time for questions. I think we've got a few minutes here. If anybody has any questions, I'd love to hear them.